Imagine the unthinkable. It is the year 2026.
The world's most famous investor wakes up, and his billions are gone. The Oracle's empire? Vanished. His reputation is intact, but his bank account reads zero. He is 94 years old, starting from scratch in a digital world. Does he start day trading cryptocurrency? Does he scour Reddit for the next short squeeze? Does he hunt for the next Tesla or Amazon? Absolutely not. To claw his way back to financial victory, the Oracle would ignore 99% of the noise on Wall Street.
Instead, he would deploy capital into a holy trinity of assets, 3 specific exchange-traded funds.
This assertion may seem contradictory to everything you have been told about wealth. Why would the greatest stock picker in history,
A man who built a conglomerate by identifying undervalued businesses, suddenly abandon the very principles that created his empire?
The answer lies in the critical distinction between professional mastery and practical wealth accumulation. What works for
This philosophy is not merely a theoretical exercise. It is written into the final instructions for the Oracle's own estate.
When the inevitable day comes, the instructions to the trustee are clear and unyielding. Allocate 90% of the and 10% to short-term government bonds, not to a hedge fund, not to a hand-picked portfolio of blue-chip stocks.
If this strategy is sufficient for the heirs of a billionaire, it warrants the full attention of every investor listening to Capivestor today.
In this deep dive, we will dissect the precise 3 ETF portfolio designed to reconstruct wealth from nothing. We will analyze why these specific funds can secure a retirement worth millions, and we will rigorously demonstrate the mathematics behind the compounding.
A geometric progression that the human mind often fails to comprehend until it is too late.
To understand the foundation of this strategy, one must look back to the geopolitical and economic climate of 1942.
The world was engulfed in war. The future of Western civilization hung in the balance, and market volatility was the only constant.
In such an environment, the novice investor often learns a brutal lesson in psychology. When share prices plummet,
This fear drives the investor to sell at the bottom, locking in losses just before the inevitable recovery.
but it is a historical truth that the market rewards patience and punishes panic.
The investor who bought during the chaos of 1942 or the crashes of 1987, 2000, and 2008, and simply held on, witnessed their capital multiply many times over. The lesson is distinct. The lesson is distinct. Time in the market is superior to timing the market. This is not just a theory, it's a proven path, simple yet profound. Reconstruct your wealth. Secure your future. It begins with understanding the power of simplicity.
Join Capivestor and unlock you financial freedom.
This principle extends beyond stocks to tangible assets. Consider the economics of farmland. A 40-acre farm purchased decades ago generates income year after year.
Completely independent of the daily fluctuations of the stock market ticker. The corn grows. The harvest is sold.
The profits are realized regardless of whether the Dow Jones is up or down.
The goal of the intelligent investor is to view their stock portfolio with the same detachment as a farmer views his land.
You do not sell the farm simply because the weatherman predicts a storm. You hold, and you let the asset produce.
Today, the modern investor possesses a tool that did not exist during the mid-20th century.
A vehicle that democratizes access to wealth creation without the need for specialized accounting knowledge. This vehicle,
For the uninitiated, an ETF acts as a diversified basket of equities.
When one purchases a single share of an ETF, they are effectively acquiring a fractional interest in
This instant diversification eliminates the idiosyncratic risk of a single company failing.
The investor is no longer betting on the success of one CEO or one product launch. They are betting on the
Historically, this has been among the highest probability strategies for wealth preservation.
The structural advantage of the ETF lies in its passive nature. Unlike actively managed mutual funds, which implies
a passive ETF simply tracks an index. It incurs minimal costs, with expense ratios as low as 0.03.
Contrast this with active funds charging 1% or 2%, stripping away hundreds of thousands of dollars in potential compounded returns over a lifetime.
Critics may argue that relying on indexes is a resignation to mediocrity. They point to the billionaires who made their fortunes picking stocks.
However, this ignores the competence gap. Institutional investors read 500 pages of reports daily. They understand corporate governance.
They model discounted cash flows, and they possess distinct competitive advantages. Yet, the data from SPIVA, Standard & Poor's Indices versus Active, reveals a startling truth. Over a 15...
If the professionals, armed with Bloomberg terminals and Ivy League degrees, cannot consistently beat the market.
Therefore, the Capivestor approach recommends a strategic allocation into 3 specific ETFs to capture growth, income, and innovation. The first ETF focuses on capturing robust growth opportunities in emerging markets.
The second, for reliable income through high dividend stocks. And the third, for disruptive innovation, investing in the technologies shaping our future.
The first pillar of this portfolio is VOO, the Vanguard S&P 500 ETF.
This fund tracks the 500 largest publicly traded companies in the United States. By holding VOO, the investor secures ownership in the bedrock of the American economy. The top holdings read like a roster of global dominance: Apple, Microsoft, NVIDIA.
These are companies with massive competitive moats, resilient balance sheets, and global reach.
VOO provides exposure to approximately 80% of the total U.S. stock market capitalization.
It is a self-cleansing mechanism. As companies falter and lose value, they drop out of the index.
As new innovators rise, they are added.
In 1980, the dominant force was IBM. In the 2000s, it was General Electric and Exxon. It is big tech. The index adapts automatically, ensuring the investor always owns the winners without ever having to predict them. With an expense ratio of 0.03%, VOO is the most efficient engine for core wealth building, historically delivering an average annual return of approximately 10%. The second component of the portfolio addresses the need for cash flow and stability. While VO chases the broad market, SCHD applies a quality filter. It selects approximately 100.
Dividends are the tangible proof of corporate profitability. A company cannot fake the cash it sends to shareholders.
SCHD focuses on sectors like financials, industrials, consumer staples, and healthcare. Its holdings include...
These are mature enterprises that generate massive free cash flow. Currently, SCHD offers a competitive dividend yield.
During market corrections, when speculative growth stocks evaporate, dividend-paying stocks tend to hold their value.
Furthermore, the reinvestment of these dividends creates a snowball effect. Each quarterly payment buys more shares, which in turn generate more.
For the investor seeking to secure financial victory, SCHD acts as the anchor during the storm.
The third ETF injects the necessary aggression to maximize capital appreciation. This is QQQ, the Invesco QQQ.
This fund is heavily weighted toward the technology and communication sectors. It excludes financial companies, focusing instead on innovation and disruption.
QQQ is the home of the growth monsters. Its concentration in companies like Tesla, Broadcom, Costco, meaning it is more volatile than the broader market. When the market rallies, QQ often leads the charge, delivering returns.
This comes with a caveat. During the dot-com crash of 2000,
Yet for the long-term investor, the returns justify the volatility. An investor who bought the absolute peak.
This is the premium paid for innovation. Companies in the QQQ invest heavily in research and development.
Their high valuations are often justified by their superior return on invested capital. Investing in
The allocation between these three funds, VOO, SCHD, and QQQ, should be dictated by the investor's time horizon.
A younger investor, perhaps in their 20s or 30s, might favor a split of 50% VOO, 20%.
As retirement approaches, the allocation should shift towards stability, perhaps 70% VOO.
Now, let us rigorously examine the mathematics of this strategy. The power of compound interest.
Let us stop talking theory and look at the raw mechanics of wealth. We assume a 30-year-old investor begins with zero. That is roughly $833 per month. We assume a conservative annualized return of 9.5% during the accumulation phase.
At the end of year one, the portfolio has grown slightly. You are in the accumulation trench. It feels slow.
By year 10, the account has surged to over $159,000. You begin to feel the momentum. By year 20, the magic of compounding accelerates, creating a balance of nearly $560,000.
But watch what happens in the final decade. This is where the mathematics of the exponent take over. You haven't just doubled your money, you have entered the stratosphere. The portfolio stands at approximately $2.5 million. The third ETF injects their aggression to maximize capital appreciation. This fund is technology and communication sectors.
QQ is the home of the growth monsters. Its concentration in companies like Tesla, Broadcom, Costco, and
meaning it is more volatile than the broader market. When the market rallies, QQQ often leads the charge, delivering returns.
However, this comes with a caveat. During the dot-com crash of 2000, the Nasdaq lost 83% of its value.
Yet for the long-term investor, the returns justify the volatility. An investor who bought the absolute peak in 2000.
This is the premium paid for innovation. Companies in the QQ invest heavily in research and development.
Your total contribution was only $350,000.
The market paid you over $2 million simply for waiting.
This is not magic. It is the inescapable arithmetic of patience.
The greatest barrier to this financial victory is not intellectual, but psychological. It is a matter of temperament. The amygdala screams to sell when markets crash.
It screams to buy when speculative bubbles form. The philosophy of Capivesta aligns with the late Charlie Munger,
who famously noted that the big money is not in the buying or the selling, but in the waiting.
It requires a stoic disconnect from the daily news cycle.
History provides the roadmap. The Kennedy slide of 1962. The stagflation of the 1970s. Black Monday in 1987.
The great financial crisis of 2008. And the COVID crash of 2020. Every single one of these events felt like the end of the world in real time.
And yet, every single one proved to be a buying opportunity for the disciplined investor.
Father of value investing, famously posited that in the short run,
The market is a voting machine, tallying up which firms are popular and unpopular based on emotion.
But in the long run, it is a weighing machine, assessing the true substance and cash flows of a business. The strategy of holding VOO, SCHD, and QQQ is a bet on the weighing machine.
It is a rejection of short-term noise in favor of long-term economic reality.
Investors often hesitate, claiming the market is at an all-time high. They wait for a pullback that may not come for years. Dollar-cost averaging, the practice of investing a fixed dollar amount at regular intervals, eliminates this dilemma.
Freedom from obligation, freedom from anxiety, and the autonomy to chart one's own course. By adhering to this triad of ETFs.
The path is boring. The path is slow, but the path is resilient. The market is a machine that transfers wealth